So welcome back. After quickly describing the balance sheet, I will briefly introduce you to the income statement. Income statement, also known as profit or loss statement, of course has a name because what you're doing when preparing it is calculating whether you have created a profit or a loss. Just before we start, it's very important to point that out. What I'm explaining now is a very simplified income statement. In case you want to or need to learn the details of the income statement, you should probably go to one of the live shows of finance. But this is just about the principle. How does it work? First position in any income statement is always revenue, also called sales. This position basically is the money that you earn by selling your products or your services. Yeah? If you're a company producing something, it will be from the sales of, the goods. If you're a service provider, like for example our school, we don't sell you any good, we provide the service of, educating you, or at least trying very hard to educate you. So this would be in this position. Next thing, minus expenses. Expenses means money that you spend on something. Very important here is some money that you spend is used for purchasing an asset. If I take 100 euro and buy a car, then it would not be an expense, it would be the purchase of an asset. The car would be an asset, you would find it in the balance sheet. What would happen is my cash goes down by 100 and the position car would go up by 100. Expenses in the income statement means something different. That is money that you pay for something where you don't create an asset afterwards. Very good example would be paying your rent. You pay your rent. What happens if you pay your rent is that you're allowed to live in your apartment for 1 month longer, but it doesn't create an asset. So in a sense the money is gone. Also the money that you spend, for example, on electricity, phone bills, this kind of stuff, that would be an expense. And of course the difference between revenue and expenses in the end would be a profit then or a loss. Like I said before, this is a very, very simplified version of the income statement, yet it's the only reason why we do that in that form is just to prove the point, to show how the system works. So again, this is revenues. The sales position is the money that you get from your operating business, from selling your products or from providing your service to your customers, minus all your expenses, salaries, wages, electricity, all the utilities, gas, water, this kind of stuff. The difference, eventually profit or loss. As you can see, there is no position taxes here. That is something, of course, I left out to make it a little simpler. Tax would also be, of course, very in the end. After calculating your net income, that is what you would use to calculate your tax payment in the end. I promised before I will also explain how income statement and balance sheet are connected. I will quickly do that. You have your income statement, revenue minus expenses equals your profit or your loss. Let's assume your company creates a profit. At the same time, you prepare your balance sheet as well. I hope you remember asset side, liabilities, owner's equity. Here you have all the stuff the company owns, building, lands, machines, cars, cash, all this kind of stuff. You have your bank loans here on the liability side and your owner's equity. This position, as I mentioned before, consists of common stock and retained earnings. So, where is the connection between income statement and balance sheet? It's actually very simple. You calculate your profit, and this is directly moved into the position equity. If you have created a profit, what happens after you transfer it here is it will increase your position equity, of course, by increasing the retained earnings. In case you've made a loss, still it would be transferred here, reducing your equity position. So let's assume a company keeps on creating losses every year. What would happen? Eventually the equity position would be zero. If you still would keep on making losses, equity position would even become negative. Just that we all understand that. A low equity, or especially negative equity, is usually, well, not usually, is always a very bad sign. A negative equity already is one condition for bankruptcy. So, very bad thing.